a little bit down, maybe even more than a little bit in the context of where we've been. And once again, we seem to be heading towards that $90 mark on Brent after what would appear as a series of attempts to divert that. Let's welcome Kieran Gallagher, Managing Director of Vitol Bahrain. First time we've had a chance to make that introduction, Kieran, so congratulations on your new position. Kieran, I ask you your thoughts. OPEC Plus, 2 or 3 weeks ago, we had the Saudi minister come out, sort of jawbone up the market as the media reported it, talking about a cut. Then earlier this week, there was a cut. I mean, one might use that word. It's generous to use it with the reference to 100,000 barrels a day. But in both cases, well, in the aftermath of both those interventions, the market rallied. It has continued to reverse and push back down. Does it require, do you think, a substantial cut of meaning in order to stop this downward motion in the oil price?
Yes, good morning, Sean. Well, I think, does it stop the market volatility or lead to more? The market was already incredibly volatile anyway. I think, $3 a barrel intraday movements are becoming the norm now, almost since the end of February. So the market was already incredibly volatile. I think that probably does continue, particularly after, we did see a little bit during August, a little bit of risk off. I think there's probably a bit risk on going into the final quarter of the year now. But I think what OPEC were doing are obviously making a statement to sort of say, well, at relatively short notice, they could come to an agreement to cut 100,000 barrels a day. That does look to have been easily absorbed by the market, but the main sort of fact remains it's a demand concern out there right now. That's rising inflation, rising interest rates. I think the trade are looking at a potential slowdown of demand, and that's why the sell-off is coming that little bit easier.
Let's welcome Malia Bengali. Good morning, Malia. Welcome back to the table, founder of MB Commodity Corner. Malia, what's your read on it? I mean, there seems to be a number of factors that are making this a weaker market. One of them seems to be lack of liquidity, lack of market actors who want to get involved. They want to stay on their summer holidays.
Thank you, Sean, for having me. It's interesting because on the physical market side, every commodity trader probably looks at the oil market tightness and wondering why the oil price is dropping. And we're talking about 2018 and 2019 being a liquidity unwind, but we think it's a lot more, something much bigger than that. This is like 2008 to put in perspective. What's happened in the market right now is when we see inventories tight today, it does not tell you what inventory will be 3 months from now. The massive economic slowdown that we're seeing across all our models in the next 3 or 6 months across US, Europe, China is going to filter into the oil market. This is all about demand. This is not about supply. Yes, there's a secular problem in energy long term. We know that. But near term, given the cyclical slowdown, we think inventories can start building very fast because demand is very weak. And that's what's confounding a lot of physical traders or oil traders for that matter. So this is not really technical. We're seeing chaos in the macro markets because demand is being repriced lower across all assets. And oil price is just a synonymous indicator of that as well.
Let's welcome Bora Barryman. Bora, welcome back to the table, Managing Partner, Hormuz Straits Partnership. You must be delighted this morning, Bora, waking up in London and knowing that Liz Truss is going to pay your energy bills over the Christmas. More bailouts, more demand for energy. Why wouldn't prices stay high?
Precisely, actually. Price caps were not the cure to inflation in the 1970s. And I'm skeptical that they will result in anything but rationing and shortages in the 2020s. Liz Truss is following the Western consensus, borrow and spend through the energy transition, which itself is inflationary, right? It's a type of fiscal stimulus. I don't find her out of line with really the governing policies of the Western Bloc, the United States and European Union in general, though. So we're going to see that these sort of expansionary policies continuing with energy transition are financed on a credit card. essentially. There are slight nuances. She is sort of giving a warmer climate. That's the wrong metaphor. She's giving warmer words toward the upstream industry in the North Sea and the fracking industry. So that's positive, I think, certainly. And she's certainly sort of emphasizing the alternative energy such as nuclear for the UK, and maybe she's a bit ahead of the curve when compared to her colleagues in Germany, who still look a bit ambivalent about bringing nuclear power back online.
But just quickly on that, Bora, I mean, all of those sort of longer term, more from the North Sea, more nuclear, et cetera. But the immediate term of essentially what seems to be in the reporting, give or take where it's anchored, but $100 billion more on the Exchequer's balance sheet. Can the UK afford that? I mean, are we talking about sort of OECD countries going to be moving towards bankruptcy with these kinds of moves?
No, I'm in line with that sentiment. You know, we are where we are because of decisions taken in the past with respect to monetary policy, fiscal policy, energy policy, and I'm not sure there's any fundamental change in those policy trajectories. So at the end of the day, these same dynamics have been inflationary until now. They'll continue to be inflationary in the future, which means a persistent erosion in the standard of living in the OECD countries, harsh pressures on the manufacturing industries, especially in Germany, which is the bankroller of the whole European project. And essentially that whole, let's say, wealth effect created post-COVID with the stimulus policies has evaporated, and people feel the pressure. And that's being translated into political pressures around the globe as well.
I actually saw on Bloomberg last night a discussion around Liz Truss and the whole new British government referencing the UK as potentially resembling an emerging market, and the associated data points for that. It was somewhat like, whoa. Kieran, I wanted just to talk a little bit about where we're going with the distillate market and the potential for switching, fuel switching, in terms of keeping a demand support for oil and oil products at this time, because oil is cheap compared to gas. I mean, it's dirt cheap. Why wouldn't you burn the hell out of it? I mean, climate aside, obviously, but ultimately in this window of this winter of great concern, how much opportunity and demand you think could come from switching?
I think it's probably important to sort of look east and west of Suez on that front, Sean. Like, I think even in the last 4 to 6 weeks, if you take east of Suez, I think we're seeing very visible switching in the likes of Egypt, Kuwait, Pakistan, Bangladesh. And so you see, well, let's say from Kuwait less supply, but the other 3 countries I mentioned there, certainly visibly more demand, and that's principally a shift away from gas burning at this price set. Now, with that, it's obviously visible in the here and now. Obviously, it's not winter yet in west of Suez, and so we're not seeing it as obvious. I think there's potential for an increase. I wholly agree. And if you're looking at on plain economics, yes, of course they should do it. I do, you know, in terms of Northern Europe, Western Europe, I think we've got to appreciate there may be some infrastructure constraints as well in terms of how much switching can actually happen, because, you know, even 2 years ago, 3 years ago, there was an eye on the energy transition and keeping it to clean fuels. But so, yeah, I think there's potential for further increase. But then we, you know, take a step back and say, well, does the market have the oil to give? And, you know, we have seen diesel builds over the summer. You could argue that we'll probably see another build certainly first half September also, before we move into that sort of turnaround period. So there is probably a little bit more that the market can lend to that sector. You've also got two diesel machines coming on in Saudi and Kuwait in terms of new refinery capacity. Whilst it will be gradual startups, I think the refineries in Jizan and Al Zour are sort of on the precipice of first runs in terms of on-spec production. So, you know, there's further supply there. Yes, there's Indian export taxes, which will curb diesel supply there. There's potential for a full shutdown in Nayara for maintenance, and there's other maintenance in North Asia. But it does feel like the diesel market has a little to give. And so if that incremental demand comes from Europe, which we would expect, it's making the guesstimate as to what degree that is. It does feel that there may be the diesel to give going into Q4.
Malia, of course, the next part of this puzzle that is adding weight to the downward pressure on economic activity is the next round of interest rate hikes are only around the corner. The Fed is now, by all predictions, going to go another 75 basis points, and maybe the Europeans and the Brits are going to follow as well. Where does that fit into this picture and the ability of to absorb such big rate rises?
You're absolutely right. So the next data point we have is the US CPI release on the 13th of September. The market's talking about a 7.5% year-over-year increase. It's lower than the July print of 8.5%, but the numbers are still very high from the Fed's 2% target. Now, whether they raise by 50 basis points or 75 basis points is irrelevant. The Fed has still got a lot of work to do to get the inflation back to their target. And Bora made a very good point. Europe and UK right now are printing so much money to save this energy problem for the consumers and businesses. You look at the relative purchasing power of currencies, you know, UK, Euro, and are just going down versus the dollar that's going up. So that's driving this dollar wedge even higher, which is making it much harder for risk assets going forward. The dollar is a big problem right now for a lot of countries and currencies, and that dollar strength is a big problem for all asset classes. And I think that the Fed's rate tightening stance is a pretty much a determining factor. They can't stop right now. They can't pivot because inflation is just too high. And that's the catch-22 situation in markets.
Bora, would you expect the same in the UK to follow the 75 trajectory, or will they stay? They've been on a somewhat lower trajectory, the Bank of England.
I would err on the side of more hawkishness, because these central bankers, they move in herds. Bankers in general, we move in herds, right? Risk on, risk off. And the message from Jackson Hole was to be hawkish. And it's a matter of credibility right now. That's the theme that we had in 2020, 2021 was they didn't have the credibility. Now they need the credibility. And this is having a follow-on effect, ramifications in many areas. One, the euro is a bit behind the curve, right? So that's at its lowest point since its inception. And therefore, we see that Brent may have come off its recent highs, but probably in euro terms, it's near historic peaks. That would probably be the same for many of the emerging market currencies. Oil is at historic peaks. Hence, there's a pressure on, as I mentioned, the manufacturing industries. Demand outlook is tempered, and OPEC reacted to that. They are also calibrating, fine-tuning their messages, and they realize that the monetary policies are going to be tighter. That will be bearish on the demand side, and they gave the signal that they will react quite nimbly to those type of demand side signals, which today are a bit bearish.
Kieran, just looking at the sort of political interventions, the price cap as of last week with the G7, the US looking to potentially block exports of diesel to Europe. What impact are these having on traders' willingness, appetite to get into the markets? Is that part of the problem?
It is, particularly particularly say this sort of marginal trader, that has limited VAR, limited risk, and looking at this sort of thing, saying, well, is it worth it? Is it worth being part of that trade? Because complete external forces could be at work. But then I think companies such as ours, the majors, etc., like that, are sort of looking and what degree of belief do you have in some of these government interventions? The one you mentioned in the US, for example, the US does, there's some political polarization there, and so a recommendation by the Energy Secretary not to export isn't governed by law or anything. It's certainly just a request, and refiners have had it tough for a few years before this year, and they're looking at these record margins and record highs, distillate cracks, etc. And they're, the marginal barrel may stay, that last cargo where do we export, do we not? And it's like, okay, maybe, we'll have a little bit of good news, we'll park it and not export. But I would expect market forces to remain, to work as normal, Sean. The backwardation in the US diesel market is 6 cents per gallon. Why would a refiner sit on that rather than export a cargo out of the US Gulf? So I would imagine that it doesn't play too much of a part.
And Kieran, just to sort of take that the next step further, as we're now 6+ months into Russia's invasion of Ukraine, and these oil flow, the changes to oil flow, things moving west to east or east to west, that are new and opportunistic in some regards. I'm wondering, are you starting to see these things bedding in as being somewhat permanent new flows, or what ones do you think may be or not? What is the outlook for that?
I'm not sure if you call it normal flows yet, but we're certainly seeing more consistency in those flows. Certainly a little more naphtha moving west to east than we would traditionally see. And you could say, fuel oil always has moved in west to east anyway, to obviously cover the bunker markets and Singapore, Fujairah, etc., like that. So, but we're, there's certain, we're seeing a pattern to the volumes now. Yes, there's spikes in a given month, or there's dips, but this can be down to lack of willing vessels, etc., and some self-sanctioning going on. Assuming we're talking about the same flows, from Black Sea and the Baltics that you asked about before.
Maliha, as we started our conversation this morning, and I think the market's going to start questioning what is OPEC willing, prepared, can do. They've shot across the bow of the market. I wouldn't say it's failed, but generally the market has returned to where it was. Where would you advise, where could OPEC defend the price if they indeed sort of want to try to?
That's a very good question, because, when right now oil price is trading close to $100 a barrel, we are still quite above the pre-COVID highs of $75 a barrel. And it's interesting that OPEC's talking about cuts today, which, so end of the day, it's very politically contentious to talk about cuts today when the whole world is battling with the energy crisis. And it's interesting. We think they'll probably start to, and this is just obviously our view, that they'll start to get worried if prices fall below 75. If prices fall rapidly below 75, we think they can probably do something. But right now, it's just a bit too politically contentious. Also, inflation is a problem. If they cut too soon, prices will spike higher. But also, don't forget, the OPEC countries are pegged to the dollar. So they, in sense, they are suffering as well. Nobody talks about the peg of the dollar in these countries. So they can't afford a spike in prices because the entire global economy can collapse. So I think there's a bit of that to be taken into account as well. But in our opinion, I don't think the real trouble starts till below probably 75. And I think they need to probably give it a month or so to see what prices do. And we can get that happen in a few weeks or a few months, depending on how the winter develops. Right now, it's a very precarious 2 months where we're before the winter demand starts and the macro slowdown, and companies are shutting down, businesses are shutting down, demand's quite weak, and no one can actually put a finger on exactly how much demand is. But we've seen the 4-week average data point down every single week that we get data.
Bora, the sort of over the horizon challenge in some ways, this winter's solutions is more about logistics than anything else, when really the sort of next winter and the demand cycles of 23, relying more on the investment of the majors and into new production, new capacity, and so forth. And despite the price point, we haven't seen, most of that money is moving into dividends, most of it's moving into buybacks. Your outlook for that to continue, or do you expect a shift back to putting some money in the ground?
I'll caveat myself. I'm not an engineer, and I don't know if the strategic investments that are being made will be successful. But I do see projects coming into play: expansion of gas storage, acquisition of new FSRU regasification units from various parts of the world where they're not optimally utilized, bringing them to Europe. And let's see if any can wean itself, as they mentioned they would in the Daily Digest, off of Russian supplies in the next 5 years. That's their target. That's their political statement. This will require investment in pipelines connecting potentially to all these projects through the Balkans, to the Caspian, as well as LNG. But will that solve the problem? That's for the engineers and the traders to decide. But I do see that there's movement.
And for the bankers, are the bankers going to lend them the money?
Well, that's a good question, because this energy sector has been so politicized, and there is where leaders can make phone calls to the systemic banks and kind of get them to back their national champions. Once upon a time, back in the 70s, the energy sector was dominated by national champions, the Eni's, the Totals of the world, and they did things for their nation's energy security. So I do think that these projects of national importance, of security of supply and redundancy, will get investment because leaders will emphasize personally to bankers that they need to take certain risks, which will be potentially underwritten. I hear this, especially with respect to the German utility sector, right? The state is underwriting whatever investments they need to make to kind of get through this period.
On that point, how vulnerable are those utilities? We're hearing potential contagion into sort of fiscal vulnerability, that they have to be able to draw on the credit lines of the sovereign.
Indeed, and it's like the global financial crisis was for banks. This is the crisis for utilities. There will be clearly either outright nationalizations or more debt from the state that needs to be repaid, and more debt representation on these boards. Will they make these companies more nimble and able to react quickly to events and markets? Possibly not, but they will be able to survive, at least to fight another day and realign themselves when things settle down. But it's not an easy period, because everything, the policy of the US and the European Union is to unplug these major commodity suppliers and good suppliers, meaning Russia and China, from the global liberal world order, so to speak. The liberal world order is being pared down to basically Europe and the United States, and then you have other non-Chinese Asian nations and African nations that are able to arbitrage sort of between the two, and I think that's where Europe certainly will focus, is on new investments linking into African, non-Chinese, Asia to get the resources
they might be a bit late. Let's go to the survey question this morning on the OPEC position. OPEC did give in their meeting the other day, the Saudi minister the authority to intervene in the market, and the question is, will they? The OPEC gave Saudi minister power to intervene to address market developments. Do you expect he will before the next meeting on October 5th. Will the market be such that, we could drop below 90 today, for example? They looked like they wanted to defend 90 the last two times they spoke. Will the Saudi minister intervene in the markets before the next OPEC meeting? Kieran, I wanted to get your thoughts on the significance or lack thereof on the question of Iran and the Iran nuclear deal. Of course, it seems to be perpetually locked in this sort of limbo of yes, yes, and then no, no. And the closer it gets to the finish line, it drifts away. Your own sense on how important, what kind of an impact that could be in the energy markets or the oil markets, if indeed they do get it across the line?
Well, I think obviously the noises coming even from the EU chief negotiator have been quite downcast in the last 2 to 3 days. So it doesn't feel like a deal is as imminent as it was maybe even a week ago.
Yeah.
Will it have an impact? Yes, it will have an impact. We do see, crude, particularly condensate stocks, condensate, fuel oil, that it will have an impact on the markets. Then the question is, will OPEC try to counter that? But I'm not sure. There's not going to be an immediate deluge, Sean. There can be a deal, but then there's follow-on obstacles such as banking and finance, insurance, shipping, etc., like that, that need to be overcome to bring that oil to market, and what market is it going to end up in. But yeah, of course it is going to have an impact, but it's again how much can come to the market within 2 months, 6 months, 12 months. And
do you buy into this sort of massive floating storage ready to come on a press of a button?
No, that's in short. I think that's yes. We do probably believe that there's quite a lot of condensate that could hit the Asian markets quite quickly. But again, I'm not sure there's a massive amount of crude or products that are there that would have like a very immediate impact.
Malia, just to wrap up on the question around sort of the interest of the funds, the net interest into the oil and commodity markets, is that softening with the general equity market outlook, or could we see money flow into commodities, into oil in a bigger way as somewhat of a hedge?
I think we can see that, in fact, people are quite long commodities still to an extent, because the entire mantra of this year was to play the whole super cycle, inflation, long, and commodities. I think money is still yet to come out, given this depletion in equities and bonds. You've seen the bond markets in turmoil. I think there are a lot of stale bulls still in commodities. In the short term, we can see a bit more pressure, but in the long term, obviously, money can flow into commodities because there's a long-term case to be made. But that long term could be a year away, depending on how bad this recession or depression could be. But the near term, we think people are still holding on to the long, especially in the oil market for right now.
Let's get the survey result to give Bora the last word this morning. No. Do you expect he will come in before the next meeting? No. I'm not sure about that. Bora, your thoughts on that piece, and also the OPEC plus. It's anything that's sort of demonstrated at the moment in the wider geopolitical context is the tightness. This seems this is a very solid partnership now between Russia and Saudi Arabia. How does that sustain? And at the same token, the US is the key actor in the Gulf as well. Could that stance continue, do you think, as it becomes more and more embedded in a world that becomes more and more competitive?
Well, clearly the national interest of Russia and Saudi Arabia, being commodity-based economies, are aligned, because you need to take care of your people first, and that takes money. Money talks, right? Especially in these societies where you can't sort of express yourself in other ways, you express yourself in economic ways. So that's very important for them to protect the position of the commodity-based economy. I voted no on that poll, but that was more wishful thinking, right? Because they would need to intervene quickly within a matter of weeks if there's further deterioration in the demand side and the global economic outlook. And I was going on and on about the Western policies, but it's not just the West. Look at China. You know, I don't know what they're playing out with this zero COVID policy. They're doing a great favor to the rest of Asia, which will increasingly, you know, gain manufacturing and technology market share, because people can't be reliant on this fickle policy that's really not aligned to sort of what we understand about the natural world. Viruses spread and they circulate. So China's policy is a very bearish factor that will cause OPEC Plus to remain sort of at the trigger.
Well, in some ways, Europe must be dancing jigs of celebration that China's holding on to its zero COVID policy, because if they were to open it up and get back into the gas markets alone, never mind other things, it would be a big squeeze that would be felt in Europe. We're going to have to wait and see. I think the question here is that, you know, can and what price the Saudis want to defend. I get the impression that they will need to defend a higher price than maybe they would have done historically. There is a huge amount of economic activity taking place in the kingdom that has to be funded, and it won't be funded with $60 or $70 oil, I don't think. I think they're going to do whatever they can to hold the line at 90, no matter what happens in the world. They don't want to be, they don't see themselves, I think, as playing the role of having to help the world out, so to speak, if you know what I mean. But we'll, you know, I think these will be interesting weeks. Will intervention be on the cards? We'll see. Kieran Gallagher, thank you so much. Really great to have you. Malia Bengali, thank you as well. Bora Berryman, thank you all for your insights this morning on the Daily Energy Markets podcast. 1 month till our forum in Fujairah. Hopefully we will see everybody there. Have a good day, everybody.
Thank you, Sean. Thank you, everyone.